Commercial real estate markets, especially in New York and San Francisco, have been hot this year. Does it all change next year? Brian Ward is here. He's president of Capital Markets and Investment Services at Colliers International. Nice to see you here.
Thank you, Rhonda. Nice to be here.
Can the market get even hotter than we've seen?
Well, it's hard to imagine that it would, given what we've seen over the last couple of years. I mean, I think what we've seen for sure is a market that's been fueled by liquidity. And that liquidity search has really occurred globally, not just in the United States. And so it's particularly personified in markets like New York and San Francisco, which you've mentioned, but we've seen it in other markets as well, Seattle and Los Angeles, and markets like Austin, where we've seen great technology growth, but even some of the other more kind of commodity type markets like Atlanta and Miami and Dallas are also on fire these days.
Is any of it, when you've got this liquidity chase, are we in a bubble anywhere?
Well, bubble is hard to say. I mean, I think we're certainly in a mature part of the market cycle. Mm-hmm. So the question really becomes, we're now roughly 7 years into this recovery. And so I don't think we've ever been in the history of commercial, at least modern day commercial real estate, 7 years into a recovery without clear signs of inflation and without really material GDP growth. And so I think we're in uncharted waters, mm-hmm. for sure.
And how much of what we're seeing is fueled by foreign investment? There's been a lot said about Chinese investment in particular.
For sure. Well, foreign investment in general and the Chinese have gotten big headline news coverage. I believe, will come in about $500 billion in total commercial real estate transaction volume for 2015. So by way of comparison, that starts to get us very close to 2007, which was the peak of the market. Of the $500 billion, I would be surprised if we saw, roughly $50 to $60 billion coming from global sources, of which 10 to 12 billion could be Chinese. Mm. Now compare that to last year, the Chinese were about 3.8 billion. So you can see just massive increase from Chinese and really foreign capital in general. The reason is because the U.S. is really showing those signs of fundamentals, that broader-based economic recovery, whereas the rest of the world's having some challenges.
Yeah. So when we talk about commercial real estate too, we should make some distinctions. So you're talking in terms of a lot of office building investment, I would assume, leasing there. But what about things like shopping malls? I would think that's an area that's struggling a little bit.
When I do speak, I speak generally of call it the big 4 or 5 asset classes, which are office, industrial, retail, multifamily, and hotels. When we talk about assets in particular and their strength, for sure, I think that the real shining stars have been multifamily. Mm-hmm. Industrial has become white hot because of this global search for yield and the yield benefits that most investors have gotten for industrial in comparison to other assets. Office, for sure, is always popular, particularly markets like New York.
Right.
It's just hard to find.
Yeah.
And the real surprise for me was the volume of investment in hotels this year. Hotels have been on fire, and they've been on fire particularly with foreign capital.
That is interesting, actually,
a
little bit surprising.
It is, yeah.
So we're talking about this chase for yield and all this money. What happens now in this environment where rates potentially are going up and might go up several times next year, depending on mm-hmm. whose forecast you look at? How does it weigh in on the commercial real estate market? And that would get us back to what we haven't seen in many, many years in terms of rising rates.
Sure. So first of all, in the short term, a move by the U.S. Central Bank, I think, has no impact on commercial real estate. There's still massive liquidity. That liquidity is not going away anytime soon, and it's pointed right at the United States, whether it be U.S. investors themselves or foreign investors. That's number one. Number two is I've been saying this for the last year, that the U.S. Central Bank's challenge with respect to rates is incredibly complex, and we've seen it play out over this last year. And while I think I'm throwing up my arms and saying I concede that the Fed will probably move rates, I think it's because they have to show that they can. I mean, they've been defending the dollar with words alone for the last couple of years, and it's time for them to put up. And I think that they do so, though, in a very dangerous at a very dangerous time because we've already seen what's going on with the European banks. We are hearing rumors from a lot of our sources in Asia right now that the Chinese might very well devalue the yuan further in the first quarter. So this further strengthening of the dollar is a concern, and you're seeing headlines around uncertainty in terms of business investment growth and the like. So the Fed has no easy task here in terms of moving rates. Again, just to be clear, I concede. I think they're going to do it, but I think it's going to be a one and done, and then they're going to have to really watch and wait to see how this whole thing plays out.
Brian Ward, good to see you here.
You as well. Thank
Thanks.
you so much. Yeah.
I'm Rhonda Schaffler for The Street.